We were talking about Juniper Networks, another one from back in the day. Made a lot of money trading options on this one too. Who's going to kick it off?
That's awesome. Well, actually, in the last year, it's been sideways. Didn't do that well. So these guys are true AI enabler. Given that Juniper Networks, they offer the platforms, they offer the cloud services supported by AI. They offer the networks, the routers, the switches, the data centers, and the AI on top of that. In terms of services, they integrate AI within the switching and routing services, so it's easier and much better network management for the clients. They offer AI enabler platforms as companies that will require a massive computational power, speed, and the top notch of AI techs. They offer them those services through racks, switches, and routers, and so on and so forth. And we can see it's B minus rated by Wise Ratings, and ICSC is looking at how they historically ranked, and this is why I've said we believe these are an inflection point. They got upgraded from C plus recently to B minus, and I think this upgrade will continue in the next couple of periods, and they will get ranked better as they improve. The company, if we quickly, if you don't mind saying, if you quickly look at their balance sheet, and this is one of the things I look at, if you look at financials, the financial tabs, and if you look at the balance sheet, we can see that these guys have, good current assets that cover their current liabilities. So in case of any shocks in the system or something happen, this company can easily manage to survive, given that their assets exceed their current liabilities. And if we take a closer look at their cash, even if we put the receivables and inventories at a discount, given that they're not going to be sold at the same price, with the cash, they cover their current liability and some of their long liability, which gives you a kind of a peace of mind that this company has a very good balance sheet. They're stable. They can absorb any shocks in the system that might arise. The other things, they went through a cycle of deleveraging from the easy money era, and they did it before ahead of time, which it's a credit to the management that they foreseen the increase in interest rates, and they started to reduce their long-term debt as it peaked around 2018. So they don't have too much debt. This is what's kind of a good in this current environment with higher interest rates, and that the Fed is expecting another 2 hikes. This is going to reduce their interest expense. Their main debt is a long-term debt, and being stabilized again. This is probably we're looking at LTM here in this case. So with that in mind, the company started growth and revenue started to pick up. And if we go to the magical tab that Maseo had, the key statistics, and I agree with him, is a great way to look at everything is relative. We can see that in terms of their trailing multiples are below historic. So if you look at price to sales, price to earning, price to book, yes, price earnings to growth is slightly higher than historic, but that's because we're saying they're at an inflection point and they're going to start to grow again. If we scroll, we can see their margins are improving after the hiccup they had it during the COVID. They suffered from the higher inflation, higher the chip, because their systems are all driven by chips, and we all know about the chips bottleneck that we had in the last 2 years. However, if you look at every other metrics, they did almost all of them. They did amazingly well in terms of growing, improving their margins, and so on and so forth. And these guys also had to change their methods, i.e. in terms of investing more inventories so they don't suffer the bottlenecks that they faced during the COVID and after with all those chip shortages. So it impacted their cash flow in the recent periods. However, my main point is that these guys are at an inflection point. They have a good market share. Their main competitor, the first name you can think about is Cisco. So if you, Maseo, if you don't mind, if you scroll up and we go to another tab that I think is very important, it's called Compare. Exactly. And if we hit industry comparison, this is going to give you where the company is positioned in terms of sector. So the first name that comes to mind is Cisco. Obviously, Cisco is a major player. If it's not, it's actually the biggest player in this domain. These guys comes at smaller scale. However, they're gaining market share, which is amazing. And again, if you look at the valuation, they are trading at a major discount to their industry, even though that they pay kind of a similar dividend and they have slightly better dividend yield compared to the sector industry. We can see, if we scroll a little bit down, we can see how their margins actually better than a lot of the companies in the industry. Management effectives, their return on equity is lower because they were deleveraging. So I think this is really good for them rather than a point to be taken against them.
And that's because they were paying down debt, right? Exactly.
So that's making their equity larger. So their equity, they're not getting the leverage that improves usually the return on equity. So is that, I think again, given that there are AI enabler, they are the backbone of any AI services because we are talking about the networks. I can't think of a company that can operate without having an established network. They have the data centers across the world. They have the AI services, i.e. they offer the AI platforms. They offer the AI services for the management that would, make things a lot easier. I know this is kind of a second hand to me because my wife is a network engineer actually, and she works in a data center company, and they use mix of Cisco and Juniper switches and routers. And they have multiple international data centers. And been hearing a lot how these guys offering now new services and AI services as a management tool. The other thing is I quickly looked at their fair valuation, which is the discounted cash flow, and using a 9%, almost a 9% WACC, which is weighted average cost of capital for this company. We still ended up with a fair value around $39, which gives you about 28% upside from the current price. So it gives you, again, another aspect on the fundamentals that this company is trading around 30 now, and I have another 26, something like this roughly, percent upside. So you have a good margin safety if we go back to, the investment style of the value investing. The company is at inflection point. They're doing better than the sector in terms of margins and in terms of growth. They're starting to pick up. So I think it's a very interesting company to be in.
You raised a point, Al, and that was that I think you started off with this company's not doing what ours were doing that we suggested. This is going a little sideways. And it seems that there's a disconnect between the sentiment pricing and the fundamental structure of the company and what it might be worth. It does look like they've struggled with supply chain management. It does look like their orders are challenged a little bit at the moment, and they are introducing or they are using AI a lot more for not only internally but for their customer solutions. And I'm wondering why you're so bullish. I know it's a good, solid B-rated company, but is your optimism looking at it from an optimistic perspective, or because it doesn't reflect the sentiment that seems to be out there in the market, which is why it's sort of a little sideways?
Absolutely. So to your point, the first thing is, I think this is what presents the opportunity is what you said is the mismatch in pricing between the fair value and the actual price, where the market see the current price of the company. And the other point is the sentiment. You're absolutely right. It seems that they're still being penalized for what they've been through recently. And analysts, we know the sales side, it takes them some time to pick on a stock until they see that, it's a little bit late when they start to move on a stock. This is the benefit of early investor. It's not an early stage investing. Obviously, this is an established company, but capturing the opportunity at an early stage. And this is why I kept saying it's an inflection point. We saw the first quarter numbers. We saw that their margins started to stabilize and actually pick up. We saw that their growth is picking up. Their revenue grew by 13% and their bottom line slightly more because of the improvement in the margins. Their inventory cycle is around the end of it, i.e. they already accumulated enough inventories where we think it's going to stabilize from here. So we're not going to see much more change in the working capital that would kind of take much of the cash flow, operating cash flow. My optimism, again, is coming from this point. In the next X period, say 3 years on average, we know AI is going to grow much faster than historically. With all the buzz and hype around the ChatGPT and the algorithms behind the ChatGPT, we already know that Google is working on, or they actually have their own proprietary Grad product for LLM, it's kind of a neural networks, the large language models. All these will require a strong backbone network where you operate this. You need a storage, you need the computational power, and these guys offer you all these in a fully rounded solution with the management tools for those companies, with the management solutions.
And at a really good price. I mean, when you look at the price of this, you can have 4 shares of Juniper for the 1 share of Jabil. That is goodness knows how many multiples when you get to Mandeep's cadence. So it's actually a very affordable stock to put into your portfolio if you subscribe to your wonderful marketing there.
Yeah. So no, you're absolutely right. So valuation, this is why branded DCF, not just by looking at the comps, but also looking at the discount cash flows. Both sides offer you a reasonable upside that gives you a margin safety. We know it takes some time for the market to catch up with the fundamentals. Sometimes it requires some news. Sometimes it requires some push from the sell side. However, this is when you get this opportunity of mispricing between the fair value and the actual prices, and you capitalize on that. Again, as you said, my optimism is driven by 2 things: by the potential growth for the AI in the next 3 years, and by the factual improvement in the first quarter numbers in the company. Obviously, this yet to be seen in their second quarter and third quarter, and so on and so forth, how they continue to do that. But given the current analysis, it seems they are on the right track. And as they improve on that, and they should start to play the catch up with the market between the fundamentals, the fair value, and the actual price.
I would say that it also like you mentioned the dividend. This company is paying a 2.8% trailing yield. Indicated is 2.9% yield, and it's increased it by about 9% in the last 5 years on average per year. There's some variability in the amount that increased, but over 5 years, pretty strong average. And that's in relative to the S&P is paying 1.5%. So that's also like one of those things that, you know, an investor, like you have a pretty strong thesis there in terms of, you know, this company is it's a bit of a turnaround stock. It's done some things right. It's trying to stabilize operations, those sorts of things, but you're also getting paid to wait. So and there's the valuation component as well, and these industry trends that you're talking about. So, you know, this isn't like, you know, taking a flyer and, you know, you're going to lose everything. You know, this company is also paying you while that story materializes. So that's an additional benefit as well here.
Absolutely. And it just came to my mind also, you've mentioned the repurchase with Cadmus, right? Which shows how the management believe that they're a good investment. Juniper had is actually still in their repurchase program that lasted for the last, I think, 2 years, and they continue with the repurchase, but they show that they see a very good investment opportunity in their company, and they're confident with the management is confident with what they're doing, so that they see the prices should be at a different level. So these kind of icing on the cake, if you would like to say, as Mandeep, you get on top of the potential upside in the capital gains, you get your dividend yield, and you see that the management is buying into their changes by repurchasing their own stocks.
Well, that was like a masterclass in how to look at the quantitative side of this, as far as I'm concerned. All right, guys, we are unfortunately coming to the end of our time together. We can do a quick rapid fire segment, or we can call it a day. What do you guys have in mind?
I think that we're probably going to be able to draw a halt under today, other than simply to say, look, you got 3 different stocks, 3 different prices. One's at the start of potentially some movement upwards that it hasn't had recently after readjustment, and you've got a couple that have been on a tear and don't really show any signs of stopping. And all of these are integral. We talked about the web. A lot of technology companies are integral to parts of a bigger system. So everything that they do, it ties into others' needs. So the health of the economy is certainly something that you can see from the health of these companies. If their orders are strong, if the technology is strong, if the market is strong, this is not cheap. This is not cheap products that are being produced. Then it suggests that the overall future, in as much as it's being reflected in the sales and profits that are being returned, are actually quite positive in the technology area. I mean, they may be different in different sectors, but in this particular instance, there's certainly a great deal of reason to be positive.
And I think I have to admit, I of course saw the company names before we got started. I was not thinking in terms of either the fact that these companies are in the same web or circles as Apple, or that these 3 companies are going to participate in a big way in this new AI push. And I think in a way it's got some moats around it. You know, it's not ChatGPT, which could be replaced by a different interface, cooler buzzwords or whatever. I mean, there are 9 million ways you can disrupt or take out a software company, but hardware, where you're in the backbone, you're in the data center, you're providing the computers that are actually serving up the information to the interface that people are looking at. You know, that's a whole nother level of business, I think.